Hello, I'm Matthew Winner, and I'm excited for us to continue our week 2 of financial management. We're in our capital budgeting section of the course. And as always, to provide a background, what we're intending to do is to go through the lecture. Towards the end of the lecture, you'll see example problems. You should pause the video, work out the example problems, and then consult the solutions that are posted on Blackboard. So let's jump right in. We're going to focus a lot on managers today, and good background reading is chapter 13, which focuses on corporate governance. The second part of our lecture will focus on the market, specifically under what conditions are financial assets priced correctly. Good reading for that would be chapter 6, which focuses on risk and return. So we have our owners, our shareholders, who employ the managers, and we have our investors. Our investors are going to be distinct from only our shareholders. Our investors will include our debt holders, our bond holders, and that's distinct from our stakeholders. Our stakeholders could be any person, entity, or group that's going to be affected by the firm or could affect the firm. So that would include our customers, our suppliers, society, governments, etc. Given that there's so many different competing interests for what the firm should achieve, a very relevant question that emerges is, what is the company's objective? What is the objective function for making corporate financial decisions? This is important because we'll use it to evaluate how our managers are performing. And ultimately, in the market, we're going to be valuing a company, essentially its equity and debt, based upon these corporate financial choices that these managers are making. So within finance and economics, when we think about this objective function, we'll think that there are basically three popular answers. The one that we're going to focus most on in this course is maximizing shareholder value. Hopefully, because we can see that the firm has investors that are both shareholders and bondholders, maximizing firm value or focusing on stakeholders can lead to different outcomes. But our focus for this course will be shareholder value. The role of financial managers. Most of this course will operate under the assumption that you are the financial manager. And as that financial manager, you're in charge of many corporate decisions, all of which have to do with cash. These decisions include, should we make this investment on behalf of the firm? Essentially, is the NPV positive? If this investment is worthwhile, how do I raise the cash to get started? How do I finance the investment? And lastly, if the investment generates cash, what do we do with it? Cash, when it comes to firms, is incredibly important, as can be seen from this article, which highlights what happened for many small businesses during the recent pandemic. The way that firms manage their cash to fund operations and to essentially have a cash reserve if ever they encounter the inability to access financial markets plays a vital role in our economy. So let's formalize the role of the financial manager. At stage 1, the manager can raise cash. How will they do that? Well, they'll sell stocks and bonds to investors. At stage 2, the manager will invest the cash. So the manager will invest the cash in the firm operations. This could be to build a new plant. This could be to take on a new product line, however the firm decides to engage. Then at stage 3, that investment is going to generate more cash. So now we reach stage 4, in which the manager has a decision to make. They can choose to send that cash back to investors in the form of a share repurchase or a dividend to stockholders or buying off outstanding debt for bondholders, or they can reinvest the cash back into the firm to engage in more operations or to engage in more R&D spending, more capital expenditures. There are lots of choices that the firm can make. The manager raises cash. So stage 1, the financial manager is predominantly going to raise cash through equity issues, meaning that you're going to sell shares of the firm to investors, or through bond issues or debt issues, meaning you're going to sell a bond to an investor. Now, in both of these cases, we have the firm selling a piece of either ownership of the firm, hence equity, or promising to pay cash back in the future in the form of a bond issue. But in both of these cases, we have the firm raising capital from investors. In an efficient market, the investors will pay exactly the correct amount for the stock or for the bond. no investor will be ripped off, quote unquote, meaning that no investor would overpay for the stock or the bond of the firm, and no investor would underpay for the stock or bond of the firm, because competition among investors in an efficient market is always going to push prices to their correct and fair value. Let's look at an example. Suppose that your firm is currently valued at 50 million, which is based on the present value of the firm's future cash flows. You want to raise 5 million in equity to invest in a project that will increase firm value by 20 million. Question 1, part A. What percentage of your firm would you have to sell to an investor in exchange for 5 million? Here we want to take our 5 million and divide it by 50 million. That's going to let us know what percentage of the firm we would have to sell off in order to raise the 5 million in equity. Part B, how many shares would this represent given that your firm previously had 100,000 shares outstanding? There are two ways we can approach part B. We can take that percentage from part A and multiply it by the 100,000 shares to find out what percentage of shares this would represent. But a better way to approach part B is to kind of do this in 2 steps. First, we're going to take that 50 million and divide it by 100,000 shares outstanding. In doing that, we'll find the price per share of the firm. Once we know the price per share of the firm, we can then take that 5 million and divide it by the firm's share price. That'll tell us how many shares we would need to issue in order to raise that 5 million. Example 2, an investor is willing to lend you 5 million, that is, buy a bond from you, as long as she is paid back with interest in 3 years. The investor demands the same annual interest rate as a risk-free bond, which offers 3% per year. In example 2, part A, how much would you have to pay back in 3 years? Here, we're going to set this up as our standard future value, present value formula. We know that our present value is 5 million. We know our R, our rate of return, our discount rate, that's going to be 3%. And our T, the level of years that it's going to be held, is going to be 3. So when we set this up, we're solving for the future value given an R of 3% and a T of 3 years. In part B, the investor believes that we're riskier than a risk-free bond. So she's going to demand a 7% risk premium on our bond. How do we solve for how much we'll pay back in 3 years? First, we want to know what our new R is. Because there's a 7% risk premium, we'll add that 7% to the 3% per year that's required for the bond. So our required rate of return is now 10%. Given that 10%, we're then going to solve for our future value just like we did in part A. And what you'll notice as you do the math is that in part B, you're paying back considerably more than you are paying back in part A. And hopefully that feels intuitive. When there's a risk premium, the investor is requiring even more compensation for lending you the same amount of money. What does that mean in real life? It means you're going to pay back more to borrow the same amount. And hopefully you'll see that when you do this problem. Stage 2, the manager invests the cash. Your intro finance course likely focused a lot on NPV. And we know that financial managers are going to always be looking for profitable investment opportunities and then trying to figure out how to fund them. So let's look at an example. Suppose that the manager wants to raise 5 million to invest in a project that would provide 3 million per year for the next 3 years. Assume that the firm's cost of capital is 10%. What is the NPV of this project? What we're going to do is set this up as a timeline. So at time 0, you have a negative cash flow of 5 million. Then in year 1, 2, and 3, each year you get 3 million. We want to take the present value of those future cash flows, the 3 million in each year. We want to add that up to the 5 million that we spend, plus the discounted 3 million for each year, and that's going to be our NPV. Hopefully, what we'll find is that the NPV of this project is positive. In part B, suppose that the project has a disposal cost of 3.5 million at the end of year 3. What is the new NPV? The way to think about the disposal cost is that, yes, in year one, we get 3 million. In year two, we get 3 million. In year three, we get 3 million. But in year three, we're also going to have to spend 3.5 million in order to dispose of the project. So we're going to set it up the exact same way. We've got a cash flow at time zero. That's the negative 5 million that we have to spend. And then we've got the 3 million, 3 million, 3 million, and now a minus 3.5 million. We want to discount all of those cash flows at the appropriate time horizon. Once you solve this problem, I want you to tell me, is this an NPV that's worth taking? Is this project something you should take given this disposal cost? Managers manage the cash. Finally, the manager must choose what to do with the cash generated by the firm's investment projects. You can reinvest the cash back into the firm, and we talked about this. You can build up your cash reserve. You can engage in more CapEx, R&D investment, etc. Or you can give the cash back to your shareholders in the form of a dividend or by repurchasing shares, or you can give the cash back to your bondholders in the form of retiring your outstanding debt. You can pay off your debt. With all of these ideas, all of these methods, we're trying to get the cash out of the hand of managers. And the main reason why is because of the agency concerns that we tend to think of. We think that when managers have a lot of cash sitting around, they can sometimes engage in really bad investments. So let's look at an example. Your all equity firm generates 5 million in cash per year. You decide to distribute all these cash flows as dividends. An investor owns 100,000 of your 1 million shares outstanding. How much do they receive in dividends every year? So there's two pieces of information that we notice right off the bat. First, 5 million every year, all cash. Cool. Second, 100,000 in shares of the 1 million shares outstanding. The investor is only going to get a percentage of that 5 million in cash that's sent out in the dividend. And that percentage is going to be the percentage of the firm that they own. So to solve part A, we're going to take our 100,000 and divide that by 1 million. That's going to give us a percent. We're going to multiply that percent by that 5 million to let us know what actual share of this dividend will the investor receive every year. Example 4, part B. Refer back to example 2B. The manager would like to retire the bond 1 year early by repurchasing it. How much would it cost to repurchase the bond 1 year before its maturity? The key takeaway from this example for 4, part B is that we have our bond that we talked about. That's the bond that has the 7% risk premium. That's why it's 7 plus the 3%. That gives us the 1.1 or the 1.10%. We notice that it's going to be held for 3 years, but in this example, we're going to retire it a year early. That's why in the denominator, we have 1.1. Okay, you can imagine that if we wanted to retire it 2 years early, what would we do? We would take that denominator and raise it to the power of 2. Managers manage the cash. The manager can also go directly from step 1, raising the cash, to step 4A, which is giving the cash back to investors. Meaning the manager can raise cash, it can issue debt and use those proceeds to repurchase shares, or it can issue equity. You can sell stock and use those proceeds to retire debt. Firms do both of these things all the time. This is called recapitalization, meaning that the managers are choosing to change the firm's capital structure, the mix of debt and equity. What are the benefits of having more debt in your capital structure? There are 2 benefits. First, debt itself has a tax advantage. And second, we continue to talk about agency concerns. Sometimes this is referred to as the discipline of debt, meaning that as an investor, I know that if managers have debt payments that they have to make, then they can't take this cash and waste it on poor investment opportunities. What are going to be the drawbacks of having more debt in your capital structure? Well, one very clear drawback is that as the firm increases its leverage, as the firm increases its use of debt, I'm going to be worried about financial distress. I'm going to be worried that if the firm defaults on this debt, if they can't pay back this debt, then as a shareholder, I'm in trouble. So you always worry about financial distress or leverage. And we'll talk quite a bit extensively on both of these later in the course. Let's look at some real world applications of how firms use cash. Our first example is going to be Facebook. When Facebook acquired Instagram, they used a mix of both shares and cash. And this happens quite often as well. And the main punchline from this article is that because Facebook used both shares and cash, as its shares decreased in value, its acquisition of Instagram became even more profitable. And you can see how, relative to the IPO, the price of Facebook was falling at the time of making the acquisition of Instagram. The next example is going to be from JetBlue. And in this example, we have a firm, JetBlue, that faces a very real business risk. And its very real business risk is this fuel cost. It's an essential part of how they are able to operate. What did the managers do? The managers used cash in order to hedge their exposure to fuel. They bought swaps, they made call options, they went through different option investment strategies that we'll learn in a few weeks as a way of sort of removing some of this risk. So the big takeaway is that as a financial manager, you are always making decisions about the firm's cash and what the firm will do with it. And these decisions have real effects on the firm. We said that you're raising cash, you're deciding how to invest this cash, and then you're deciding what to do with this cash that you have. Do you put it back into the firm? Do you give it back to shareholders? Our next part of this lecture will focus on the efficient market and specifically conditions under which stocks and financial assets will be priced correctly.